So how often do people hide assets in a divorce case, and what can you do about it if you're the party to a divorce? As a licensed private investigative agency, one of the most common and increasingly common types of cases we work on have to do with asset searching in a divorce case. Look, a few years ago, it used to be that most asset cases had to do with a judgment lawsuit or litigation or some type of insurance claim. But over the last 24 to 30 months, the most common type of request for asset searching has to do with divorces. And it's usually one party suspecting that the other party is concealing assets. As a party to a marriage, you would know what the assets should be. How much income was there? How much cash in the bank was there? How much real estate holdings were there? And when those things don't add up, when a divorce is happening, you're going to be suspicious. So you run an asset search. I can tell you this, having done thousands, probably tens of thousands of asset searches in the family law category, 90-something% of the time, there are more assets found in the search than the client thought there was. So how do parties hide assets in a divorce, and how can they be discovered? Well, first, there are 14 different classes of assets. One class of assets, as an example, are bank accounts. Another is real estate. Then there's vehicles. Then there's corporate assets. There's intellectual property, intangible assets. There's UCCs. There's many different types of assets, and each one can be searched separately. But the most common 2 or 3 are bank accounts, real estate, and corporate assets. And what parties try to do is to place assets in a class and even in what's called a vesting or a titling where it's not going to show up in their name. Sometimes what people will do is they'll quit claim real estate into somebody else's name. They'll put a bank account in a close associate name, so that way it doesn't show up in their name. They'll maybe underreport their income with their business, especially if they're self-employed. Sometimes they'll do it in collusion with their boss. They'll tell their boss, look, lower my salary and my commissions for some period of time, and then after the divorce is done and the spousal settlement and the child support is done, then we'll raise it back up and we'll collect the difference in an accumulated account. Sometimes what will happen is a party will underreport the value of an asset. They'll say that I have some business that I own, but it's only worth X amount. All of these can be discovered and revealed through proper asset searching, asset tracing, and asset forensics. It's not enough just to do an asset search and to find assets. You have to do forensics on what's called the flow of funds, showing where assets went from one to another. Because what these parties will do when they're concealing assets is they'll try to hide them by constantly shifting it from one place to another. And by doing that, the fraudster, as we call them, thinks that they're hiding assets, but really what they do is they make the process of discovering them easier, because every time there's an activity with an asset, it gets shifted from, let's say, vehicles to real estate or real estate to cash or bank accounts. That activity creates a paper trail, creates a footprint. It creates what we call breadcrumbs, showing that asset shifting from one place to another, one person to another. I can guarantee you, if you suspect that another party in a divorce case is hiding assets, they probably are. And as a side note, this also goes for other types of family law cases. Probate cases are famous for this. Wills. Somebody's deceased in your family and you think that one party is hiding assets. It's probably true, because that happens a lot too. But back to divorces. When a party to a divorce is trying to hide assets, they're basically trying to cheat you out of your share of that asset, usually half. So if somebody can take 200 or 250 or 300,000 and shield it from discovery, they're taking 100 or 120 or 150,000 out of your pocket for their benefit. One of the biggest reasons that a party to a divorce will do this is because they believe that they're never going to get caught. They believe it'll never be discovered. And they're going to believe that for a few reasons. First of all, their own attorney might even tell them, no one's ever going to check this. Never going to come out. Number two is, they believe that their activities for concealing these assets will be sufficient. Little side note, people who conceal assets one time for a divorce are very amateur in their skills, in their methods. Even people who conceal assets for a living, high-end narcotics traffickers, Ponzi schemers, embezzlers, even people who have the time and money and experience hiding assets, there's not much they can really do to hide assets completely. So especially somebody who is in a divorce case, first time in their life ever really trying hard to hide assets, it's not going to work. The assets can be found. They don't think they can be found, but they can be found. The third reason that a party in a divorce case is more likely to hide assets now than they were in the past is because the value of family estates is much higher than it used to be. In the past, a family estate was $100,000, $150,000. Now you're talking $700,000 to $800,000 with home equity, retirement accounts, bank accounts, maybe vehicles, corporate and commercial ventures. So it's worth it to try to hide a few $100,000 where it wasn't really worth it to try to hide 20. And quite frankly, it's not even worth it to try to find $20,000 through an investigation. Just take more time and effort than it's worth. But to find 200 or 300 or 500, that's worth it. The most common methods that a scammer or fraudster will use is to try to conceal the ownership of that asset by putting in somebody else's name or leaving it off a report. As you probably know, as a party to a divorce, when you start your divorce case, you have to fill out a financial affidavit or financial disclosure. Every state has a version of this. And even if there's not a formal version, your attorney, if they're any good, are going to make both parties disclose what their assets are on paper, in writing, documented, formal. It's not going to be left to chance. You want to get that disclosure done even if you know that the information is misrepresented, because it's going to give you a documented, under oath version of what they're saying the assets are. Keep that documented no matter what it says. Then do your asset search. See what matches, what doesn't match. If you find bank accounts that didn't show up on the disclosure, keep that in mind. If you find real estate that didn't show up on the disclosure, keep that in mind. Because there's going to come a time when you will have the opportunity to present that asset search as evidence in court to show the other party and also the court itself, the judge, that the party is not acting in good faith. And if you do that, not only can you get those assets brought back in, but in many cases you can get other damages or benefits to you. Sometimes attorney's fees paid to you. Sometimes you can get more discovery of the person's finances. So how are some of the methods that assets are located? In most cases, a large asset is discovered through the discovery of a small financial event. For example, we'll give you 3 or 4 examples. Let's suppose a person takes a piece of real estate and puts it in somebody else's name, or they hide it in an LLC, or they don't disclose it. Real estate is not a passive asset. You have to pay other expenses for that real estate. Taxes, insurance, HOA fees, utilities, maintenance, repairs. Every piece of real estate has many, many expenses, some every month, some a few times a year. Each one of those expenses represents a payment, an activity. It leaves a paper trail. So even though a person might go out of their way to try to hide the ownership and purchase of a piece of real estate, it's going to be hard to hide 3 utility payments every month, a tax payment every year, insurance payment every 6 months. Those payments have to come from somewhere. You can't pay them in cash, practically. They have to come from some debit card, credit card, check. So throughout the course of a year, if there's 3 utilities, let's say electric, water, and gas, let's say, and that's 3 times 12 months, that's 36. You have 2 tax payments, that's 38. You have 2 insurance payments, that's 40. Not counting HOA fees or cutting the grass or anything else. You have at least 40 financial activities related to that property. I can guarantee you, doesn't matter how diligent that person is, they're going to slip up on one of those payments, figuring, no one's going to see that I paid a check for $182 for the electric bill. No one's going to notice I paid $32 for an HOA. Well, most people might not notice. But a thorough, diligent investigation through all the financial records will find that payment. They will also find, more than likely, when that property is purchased, there's a settlement statement, a HUD-1 statement, that has all kinds of activities with realtors, brokers, escrow companies. Every one of those activities creates a financial record. And diligent searching will find that. Let's talk about bank accounts. A person may open a bank account in their name, figuring that no one's going to know. I opened that at a different bank that I normally do business with. I put money in there. No one's going to know unless I disclose. And they may believe that because they have found out that bank accounts do not appear on credit reports. If you run someone's credit report, Equifax, TransUnion, whatever you want to run, bank deposit accounts do not show up on credit reports. Only debit and credit type instruments, loans, car loans, bank loans, mortgages, credit cards, show up on a credit report. A bank account's not going to show up there. There's not even going to be an inquiry from the bank checking their credit. We'll talk about that in a minute. So they're going to figure, I'm going to open a bank account and put money in there, and no one's going to know anything about it. Small little bank down the street, maybe a large bank in another town, I'm going to hide it. However, that bank account also creates activities. There may be interest payments, even small amount, even 2 cents interest. Most banks these days pay very low interest, but it might be 2 cents. There might be activity fees. Might be a fee every month, maintenance fee, $5. There might be an annual fee. There might be a debit card associated with that account that has activity. There might be SWIFT code activities for that account. Every time a person checks their balance, every time they go to an ATM to take out a few $100s, to tap some of that money. Maybe they put money in. Maybe they transfer funds. Every activity within that account, even activities that the bank initiates, the person hiding the money doesn't have to initiate the activity. They don't have to take out a withdrawal, make a deposit. Even if that person says, I'm not going to touch that account, I'm going to leave it be, I'm not going to do anything. Even if they do that, the bank itself is going to create activities every month just to ping the account to make sure the balance is there. Maybe creating the statement creates an activity. Each one of those creates a SWIFT code that's an activity that can be discovered. In addition, the bank account is a lot of times used to fund other activities. Maybe if the person has a secondary relationship that they don't want to have discovered. Maybe they have a business that they don't want anybody to know about. Those will show up in that bank account. Even if not, bank accounts can be searched. How else do people hide assets? There's another scheme that's called a certified check rotation scheme. So what people will do if they want to get clever is they purchase a cashier's check in the amount of money they want to hide. Let's say you want to hide $200,000. You purchase a cashier's check for $200,000 made out to you as the hider of money. And you put it in a safe place, safe deposit box. You put it in your safe at home, your file cabinet. Keep it in your wallet. And every time you want to take some money out, you take that cashier's check for $200,000, you go into the bank, you get $2,000 in cash, and then a check for $198,000. It's almost like a bank account you carry in your pocket, and they can rotate through that as time goes by. That can be discovered. Obviously, this day and age, people hear a lot about cryptocurrency and NFTs and digital assets. Is that a way to hide accounts? Well, you can buy Bitcoin, Ethereum, NFTs, non-fungible tokens, which is a way to own digital assets. Each one of those creates a record 3 times. One time when it's transferred from fiat currency into the digital currency. While the digital currency is owned, there's a footprint, a fingerprint of that currency through several wallets that's public information. And then when it comes back from digital currency into fiat currency or another asset, it creates another record. Many amateur fraudsters are not aware that digital currency creates such a record. So if you are a party that somebody's trying to hide assets, a proper digital currency or NFT search will discover those assets. Most importantly, you want to go deeper than just searching for the asset. You want to do what's called forensics on the records, to look what's behind the records. Look, if you just find a piece of real estate owned by Joe Smith, but you don't take the time to read through the deeds, read through the mortgages, look at the margin notes, get a copy of the financial or the settlement statement, and cross-reference all the names on that document, the notaries, the witnesses, the title company, the bank, everybody involved, even the attorneys, you are going to miss out on finding other assets, because in most cases when somebody hides an asset, the clues for that asset are referenced on other assets. So if you just look at direct reporting, you're going to miss the chance for discovery through indirect reporting. Now, it takes more time. If you just do a simple asset search online, press a button like a Google search, you're going to get 15 or 20% of the hidden assets. If you do a fully documented forensic asset search, that's when you get to the meat of all the hidden assets. That's what investigators do. You could do this, you're searching yourself, but don't expect that it's going to be something as simple as paying $20 to, White Pages Direct or People Finder or any of the online asset search reports that people claim are $20 or $30, $40. You're going to have to do a lot of manual research and reading of documents. When an investigator does an asset search, the biggest part of the cost is from labor. It's from time. A proper investigation will have a experienced, trained investigator spend 12, 14, 15 hours sometimes reviewing documents, searching the document, sure, but then reading through each document. I'm not talking about reading web pages. I'm talking about reading paper documents that have all the true information on them. Assets are not data. Assets are records and paper documents that need to be cross-referenced and analyzed. It's kind of like if you watch any of the cop TV shows, you watch Law and Order, and they do, let's say, DNA test. A DNA test is not just gathering the DNA on a swab. The DNA test is actually a scientist taking that, spinning it in a centrifuge, pulling the records out, reviewing it under microscope, seeing what it means, matching it up with other records, right? Swabbing the party takes 5 minutes. The actual DNA research might take days. That's the same thing with asset searching. Asset searching is like a DNA test. You're going through many, many steps of analyzing records. If you are a party in any kind of litigation, but let's say a divorce case, that suspects that assets are hidden, and you want to get to the bottom of it, make sure that you're looking at all the different asset classes, not just bank accounts, not just real estate. You might hear corporate assets and say, well, that person doesn't have any business or corporations. Well, they may not. However, they may be hiding assets within an LLC. Maybe an LLC that they put in somebody else's name. Maybe they're hiding it in a business bank account in somebody else's name. Maybe in PayPal. Maybe in Stripe. Maybe they're hiding assets in a fake business, a shell company. Look, if it's important enough for somebody to hide 100, 200, 300,000 or more in assets, it's worth spending $50 or $100 to form a corporation. Even if they're not in business for themselves, even if they work for a company, they may file a shell company just to hide assets in. What can you do to search assets? Well, start with the two easiest ones, real estate and bank accounts. Start with those two first. If you're going to search real estate records, search only at the county recorder's office. Do not search any online databases. They're not accurate. Also, do not search the tax assessor's office. The tax assessor simply shows you who is paying taxes on the property. They don't necessarily show the owner. Sometimes the owner is the one paying taxes, but if somebody's hiding assets, they're going to maybe put the tax payee in the name of an accountant or a friend or somebody else, even though the deed's in their name. So, amateur mistake, looking at tax assessor. Look at the deed recorder. Two different entities. They might be in the same building. They might be down the hall from each other, but the tax assessor and deed recorder are two different people. When it comes to bank accounts, make sure you search all of the three available sources of banking records. One is the SWIFT code system, one is the check verification system, and the third is the account vetting system. Each one has methods of research that can be done to find indications of records of bank accounts, retirement accounts, brokerage accounts, stock accounts, anything that's a deposit account that you think that your counterparty, spouse, whoever it is using, those can be searched. And you don't want to skip any of them, because if you search, for example, the SWIFT code system, you might find that there may be a bank account that doesn't show up there that does show up in one of the other sources. If you search in only the check verification system, if it's a small bank or a credit union that doesn't report there, they may show up in the account vetting system. So you want to search all three. Even though it's going to take a little longer, each search is going to take you a couple hours, and they'll have some fees associated with it. You don't want to leave it to chance. If it's important enough to find hundreds of thousands of dollars, spend the extra hour or two of search time, spend the extra, whatever the fees are for that source to get all the records. I know it's inconvenient, and sometimes the thought of sitting down for 2 hours to doing another search might not seem appealing. In the long run, it'll be worth it, because look, when we do an asset search and we run all three, it's very common that one or more of the search sources is missing one of the bank accounts that may be the smoking gun that's holding all the money and showing that that party is deceiving you by hiding assets, showing that they are not disclosing all the value that is rightfully yours. Look, if this marriage is breaking up for whatever reason, it's breaking up for a reason that there's probably a breach of trust in that marriage. And if there's a breach of trust in one area, why wouldn't the person try to hide money? There's no reason not to. If you're going to be dishonest in one area of the marriage and break down trust, why would you be honest in another area? Right? So make sure you do your full search. Make sure you don't skip any steps. One other story about the length somebody went to try to hide assets was a party that attempted to conceal assets by purchasing precious metal, figuring they could hide precious metal. Companies these days in certain businesses have what's called a KYC requirement, know your customer. Even though you're not a bank, if you're a jewelry dealer and you're taking payment from somebody, you have to file some reporting. in many cases. And it doesn't have to be just over $10,000. It can be any amount. And once that reporting is done, that creates a record that shows that those assets were purchased or had some beneficial interest by a party. Get what's rightfully yours in a divorce case to make sure no assets are being sidestepped from the proper distribution in that divorce.